And I'm going to show you another scorecard. There's only 3 big ones. There's lots of little ones, but there's 3 big ones. The second scorecard, I'm going to draw to look like this. And the reason I'm drawing it to look like this is because this number right here is what everybody tends to look at when they get their scorecards. This particular scorecard is called an income statement or a statement of operations or a P&L, profit and loss. So that's one of the things accountants do. I mean, they give everything 14 different names to keep you guessing, right? What are you talking about? You're talking about P&L, all right? I don't know what that is, but I do have an income statement, right? So this is an income statement, a P&L, a statement of operations. All of it means the same thing, and it's really divided into 2 parts. The top part is you got revenue or sales or turnover. Turnover is what they call it in some countries. Sales or revenue or turnover. And then you deduct out all the expenses, and what you're left over with is the profit, or the earnings is another way to say it, or the net income, right? The net income of the business. Now, anybody here ever gotten financial statements on your business? Yeah, most people have. Some people don't. Some people don't get financial statements. Instead, what they do is once a year, whether they need to or not, right? They look at their tax return. Now, you talk about a bad idea. Number one, looking at the numbers only once a year, that's a bad idea. And number 2, looking at a tax return to figure out what's going on in your business is a really bad idea. Because it doesn't tell you the information you need to know. And yep, that's what a lot of people do, which helps explain why most businesses don't beat the odds. I mean, holy cow, if we're going to go to all this trouble, we're going to have all this work, why don't we get the skills to fly the plane and not die, not crash? All right. Revenue minus expenses equals profit or earnings. Now, what you do, if you're typical, and most people are, what you do is if you get financial statements, which only 50% of business owners get them, 50%, and of the 50% that get them, only 3% know how to read them. Those numbers are starting to sound suspiciously like the success ratio, isn't it? No wonder people are having so many problems. What you do when you get financial statements, if you get them, is this is the first number you look at right there. You look at the bottom line. That's what it's called, the bottom line. And if this number right here is a particularly good number, you'll go have a drink. Am I right? Yeah. And if this number's a bad number, you'll go have a drink. Am I right? Yeah, so everybody's looking right here, and they're looking at this number. If it's good, they drink, and if it's bad, they drink. Which is another reason why most businesses don't succeed. Most business owners are alcoholics, right? They're looking right here. Look, is there a difference between a business whose revenue is 100 and their expenses are, you know what, we're going to make this 10. The business has revenue of 10, their expenses are 6, therefore their profits are 4. Does that make sense? Is there a difference between this business right here and a business whose revenue is 1,000, whose expenses are 996, and whose profits are 4? Is there a difference between these two businesses? Oh, there is. Yeah, you're right. And yet, when you look at their profits, they're exactly the same. So most people are wandering around, drinking over this number right here, and I'm about to say something you're going to disagree with initially, but you're going to find out why I'm saying it in a minute. What I'm going to tell you is this whole piece of paper, the whole entire piece of paper is a theory. There's nothing real on this piece of paper. It's a theory. It's an important theory, but it's a theory. It's the theory of, does revenue exceed expenses? If so, by how much? Do expenses exceed revenue? If so, by how much? In theory. In theory. Here's why I'm telling you it's a theory. The reason it's a theory is because you can't spend profits. Try to pay your bills with your profits. Check out of this hotel and say to the cashier, God, I don't have any cash. Will you take some of my profits? Will you take some of my retained earnings? Watch and see what they'll say. They will slap you. They don't want your profits. Your profits aren't real. You can't spend your profits. They can't spend your profits. The profits are a theory. You'll see why in a minute. It's an important theory, but nevertheless, it's a theory. This piece of paper is different from a balance sheet. This one's called a balance sheet, obviously, because the left side equals the right side. It balances, right? 100 equals 100. 100 equals 80 plus 20 equals 100. 100 equals 100. So this is a balance sheet, and this is a snapshot. And this is an income statement, and this one is a movie. This one is a movie. This one is over a period of time. This one says, for the month of January, for the year 2008. So this piece of paper has got a beginning and it's got an end. It's a movie. Whereas a balance sheet is like a snapshot, just a digital, this is the way it looked right then. And this one is what happened over this period of time.